Welcome to the Deep Dive, your shortcut to getting up to speed. Today, we're digging into, well, a bit of a puzzle from the Universal Insurance Holdings Q2 2025 earnings call. That's ticker UVE.
Yeah, it's a fascinating one. You look at the headline numbers, they look great, strong beaks, but then the market reaction, not so much. A bit of caution there.
Exactly. So what's really going on, that's what we want to unpack today.
Right. We'll look at the financials, what management said, the strategy, and try to figure out why there's this disconnect between the results and the market sentiment.
And hopefully give you a clearer picture of where Universal might be headed in this, well, let's face it, tricky insurance market.
Definitely dynamic. So let's start with those top-line results you mentioned, because they were strong.
They really were. Adjusted diluted EPS, $1.23 for the second quarter. That easily beat the consensus estimates by nearly 10%.
That's a significant beat, yeah. And revenue was the same story. Came in at $400.9 million. That's an 11.2% beat over forecasts.
So purely on EPS and revenue, you'd think, okay, smooth sailing.
You would. And it wasn't just those two metrics either. Look at the premiums. Direct premiums written, that's new business, basically up 3.2% year over year. $596.7 million.
Okay.
And direct premiums, earned the premiums, covering the risks they actually took on during the quarter, up even more, 6.7% to $523.4 million.
So growth on both fronts there.
Right. And even net premiums earned, which accounts for reinsurance costs, that saw a solid 4.4% increase. Hit $360.2 million.
Then the profitability metric, return on equity.
Adjusted ROE for the quarter was 29.4%. Very robust. Any company would be happy reporting that.
Okay, so this brings us squarely back to the big question, the reason we're doing this deep dive. If the EPS beat was big, revenue beat was big, premiums are growing, ROE is strong, why the caution?
Exactly. Why did the stock dip after the release? What did investors pick up on that wasn't immediately obvious in those headlines?
That's the puzzle. And I think the answer starts when you look past the top line and dig into the profitability ratios.
Precisely. The net combined ratio, that's the key one for insurers, right? Measures underwriting profit. It actually increased, went up 1.9 points compared to last year, landing at 97.8%.
Now, okay, under 100% still means they're making money on underwriting, which is good, but an increase isn't what you want to see.
No, it signals margin pressure. Less efficient core operations, essentially. Even if still profitable, the trend is heading slightly the wrong way there.
And what drove that increase? Can we break it down?
Yep, two main parts. First, the net loss ratio, that's claims paid out versus premiums earned, that went up 1.7 points to 72.3%. So claims costs are rising relative to premiums.
Okay, that's significant.
And second, a smaller bump, but still there, in the net expense ratio, up 0.2 points to 25.5%. That covers their operating costs, salaries, marketing, IT, all that.
So claims costs are up, and the cost of doing business is also nudging up, both squeezing that underwriting profit.
You got it. It's like seeing your sales rise, but your production costs and overheads are rising even faster. Eats into your profit margin.
Did management give reasons for these increases?
They did. They pointed mainly to two things. One was a higher ceded premium ratio. That's the slice of premiums they pay out to reinsurers to share the risk.
Right, like buying insurance on their insurance policy.
Exactly. Especially important for hurricane risk in Florida. So a higher ratio means they're keeping less of the premium pie, though maybe reducing big potential losses.
And the second factor?
Elevated policy acquisition costs. Basically, the cost of getting new customers onto the books. They specifically linked this to their push to expand outside of Florida.
So the growth in other states comes with higher initial costs. That makes sense. Marketing, setting up operations.
Precisely. It's an investment in diversification, but it has a short-term impact on expenses.
And speaking of that expansion, you mentioned the geographic split in premium growth was interesting.
Yeah, it really highlights their strategy. Overall, direct premiums written were up, sure, but that was heavily driven by a huge 25.4% jump in states other than Florida.
Wow, 25%.
Yeah. And that big increase outside Florida actually offset a small decrease in their home state. Florida premiums were down 2.5%.
So a clear strategic shift towards diversification playing out in the numbers.
Absolutely. Which naturally leads to the question, how are things looking in Florida? It's still their biggest market, and it's notoriously competitive.
Right. What did management say about the competition there?
CEO Steve Donaghy was pretty clear on the call. He said, essentially, they're not driven by the competition. They're driven by their own data and, quote, 25 years of experience in Florida.
Confidence in their own playbook.
Seems so. He acknowledged there are more competitors now than, say, a year ago. but he characterized it as seeing only pockets of competition, not some sort of statewide aggressive price war, or, as he put it, a hungry appetite for risky business.
Interesting phrasing. So they don't feel pressured to chase market share at any cost?
That was the message. He stressed they're using their long history, their claims data, to be selective, to underwrite business they believe is profitable based on their ground-level knowledge.
And they're even expanding within Florida.
Yeah, he mentioned opening up some additional territories within the state, where they feel their underwriting approach gives them an edge. It suggests they see opportunities even amidst the competition if they stick to their discipline.
Okay, so strategy relies heavily on experience and data. How does that tie into their capital situation? Profitability ratios ticked up, but what about their financial strength?
That was another area management sounded confident about. CFO Frank Wilcox used the word abundant to describe the holding company's capital.
Abundant, that's not hedging.
Not at all. And he linked that strong capital position directly to their share buyback program, said it allows them to be opportunistic.
And they were buying back shares?
They were. Repurchased about 287,000 shares in Q2, spent $7.4 million, and they still have roughly $15.2 million left under the current authorization.
Plus the dividend.
Yep, declared the regular quarterly cash dividend too, 16 cents per share. So returning capital to shareholders remains a priority, backed by that abundant capital.
It's definitely a counter-narrative to the margin pressure story. Okay, what about reinsurance? That's always huge for Florida insurers.
Absolutely critical. And here, there was some genuinely positive news, I think. Their new reinsurance program kicked in June 1st.
Right, covering the main hurricane season.
Exactly.
Yep.
And the key takeaway was the cost. As a percentage of their direct earned premium, the cost was broadly in line with last year's program.
Okay, why is in line considered good news here?
Because last year, Florida had 3 landfalling storms. Typically, after a year like that, you'd expect reinsurance prices to spike significantly as reinsurers get nervous and demand higher rates.
Ah, I see. So stable pricing after a bad storm year is actually a win.
A big win. Management seemed really pleased. They framed it as a positive sign for the whole Florida insurance market, maybe indicating things are becoming a bit more rational, reinsurers more willing to offer capacity at stable prices.
That's potentially very significant for future costs. Anything else on the financial health front? Reserves.
Yeah, they made a point of saying there was negligible prior year development, which sounds technical, but it basically means no bad surprises popped up from old claims.
So their past estimates of claim costs were accurate.
Pretty much.
Uh-huh.
It suggests they're reserving the money set aside for future claims. Payments is solid and disciplined. Clean reserves, basically. Yeah. No skeletons rattling in that closet.
Good to know. Did they give any specific numbers for what they expect going forward? Guidance?
They did. For the fourth quarter of this year, 2025, they're guiding to EPS of 79 cents and revenue of $369.85 million.
Okay.
And looking into early next year, Q1 2026, the guidance is EPS of $1.20 and revenue of $367.83 million. So investors now have those specific targets to measure against.
Right. So pulling it all together, that gap between the strong beats and the market's cool reaction really seems to boil down to those profitability ratios.
I think so. The rising net combined ratio, the higher expense ratio, investors seem laser focused on those, perhaps seeing them as a warning sign about future earnings quality, even if the current numbers look good.
It's that concern about sustainability, right? Is this level of profit repeatable if costs are creeping up?
Exactly. For insurers, that combined ratio is just so fundamental. A rising trend can worry investors about everything from credit ratings to capital needs down the line. It looks like the market prioritized that underlying trend over the single quarter's beat.
So the company's path forward really hinges on managing those ratios while executing the multi-state growth plan.
That seems to be the core challenge and opportunity. Leveraging that Florida expertise, being disciplined there while successfully scaling up elsewhere profitably, and of course benefiting from any stability or improvement in the reinsurance market.
That stable reinsurance cost is a potential tailwind they really need, especially if internal costs are under pressure.
Absolutely. Right. So the key things to watch going forward will be, can they flatten or reverse that combined ratio trend? Is the growth outside Florida translating into profit or just higher costs initially? And what happens with reinsurance pricing next year?
Their whole story seems to be about turning that deep experience and strong capital into better margins and a bigger sustainable footprint.
Well put. It's about proving they can manage the costs and execute the growth strategy effectively.
Okay, let's shift gears. Time for our wild yet plausible trade idea segment. Given everything we've discussed, the strong capital, the buybacks, but also the market's focus on rising ratios. What have you got?
All right, how about this? A ratio reversal arbitrage. It plays on that very tension.
Intriguing name. Go on.
The idea is you go long UVE. You're betting on management's experience, their abundant capital, and their track record. You believe they can get those ratios under control as the out-of-state business matures and their underwriting discipline pays off?
So betting the market is currently undervaluing their operational strength.
Exactly. You think the market's overreacting to short-term noise. But then to hedge, or potentially amplify, you simultaneously short a basket of other regional insurers.
Which ones?
Ones that maybe don't have Universal's reported capital strength, or lack that quarter century of specific Florida hurricane experience. Maybe newer players or ones showing more signs of strain.
So the thesis is Universal outperforms these weaker peers as the market eventually recognizes operational differences.
Precisely. You're betting that UVE sees a re-rating as they demonstrate margin control, closing the valuation gap the market's currently showing. It's a relative value play. Long the experienced, well-capitalized player, short the potentially weaker ones in a tough environment.
A bet on the veteran navigating the storm better than the newcomers. Okay, I like it. Wild, plausible.
That's the idea.
All right, so to wrap things up on Universal Insurance Holdings Q2 2025, strong headline numbers, EPS and revenue beats were definitely there, growth, solid ROE.
But tempered by that investor caution, focus squarely on the rising combined and expense ratios, a sign that underlying profitability trends matter, maybe more than headline beats.
Management, though, projecting confidence. Leaning on their deep Florida experience, their strong capital position, continuing buybacks, and that positive reinsurance outcome.
They believe they have the tools and the know-how to manage the pressures and execute their diversification strategy effectively.
So definitely one to keep an eye on, watching those ratios and the progress of their expansion. As always, remember, this discussion is purely for informational purposes. It is absolutely not financial advice.
Please do your own research and due diligence before making any investment decisions.
What are your thoughts on UVE? Did the market get it right, or is management's confidence warranted? We'd love to hear your take. Thanks for joining us on The Deep Dive.